We're going to be talking to Craig, who's the obviously manager of Alliance. I've written Alliance Trust there, and that obviously should be Alliance Witan, which is the whole point of this, that we're talking about the merger. So we've got some slides, and I'm just going to let Craig tell us a bit about the trust post the merger, please.
No problem at all. Thanks, James, and hello to everyone. So, yeah, as you say, we've had the merger take place in October between Alliance Trust and Witan Investment Trust to create Alliance Witan. On the first slide, what we've done is really just make the point that the overall objective is completely unchanged. So for historic Alliance Trust investors, no change whatsoever. The trust's objective is to be a core investment that delivers a real return over the long term through a combination of capital growth and a rising dividend. Now, we think that if we do a good job in achieving that objective over the long term, we'll produce returns well in excess of the MSCI All Country World Index. But ultimately, our objective is to produce that real return. Now, probably worth starting with, why did we do the deal? What was the thinking behind the board's decision to do that? And ultimately, it was because it was felt that that was undoubtedly in the interests of shareholders, and from a few angles on that. Firstly, it meant that the costs of the trust come down. Now, it's difficult to say exactly what the OCR is in any particular year because it's based on the average assets that you've got over that period. But we think that on an ongoing basis, the OCR on the trust will go below 0.6%, so in the high 50s in basis point terms on the trust, which we think is incredibly competitive for a multi-manager approach. You typically see fees much higher than that. So that was one reason for doing it. The other reason is really all around a higher profile for the trust generally. That means that there'll be interest from new investors. So, for example, it was announced last week that Alliance Witan will be entering the FTSE 100 at the rebalancing this month, which I believe is on the 20th of December. That means clearly there's going to be trackers following the FTSE 100 that will be investing in this, but it also means that in a larger, more liquid vehicle, it might attract new investors that might have stayed away from investment trusts in the past. And so all of that could lead to the discount tightening even further. I mean, we're already at a much tighter discount than the rest of the sector, but if that continues, you could potentially see that come to zero or indeed move to a premium, which again is all in the interests of shareholders. And ultimately, we think the future investment trust is going to be attracting retail investors directly, and that allows you to do that with that higher profile. A bigger trust means you can spend more on marketing, getting to those investors, which again has a positive impact on the discount to NAV. So that was the reason for doing all of this. What were the practicalities? Well, what we've got on a slide here is what the Witan portfolio looked like at the end of August, and what the Alliance Witan portfolio looks like as of today, or end of October, which was the month in which the transition took place. And you can see on the left-hand side that there were 3 managers that we pulled out that have come into the Alliance Witan portfolio. So 2 of those managers were already in the Alliance Trust portfolio. So that's GQG's emerging market portfolio, and that's Veritas running a global equity portfolio. Veritas, we've moved them to the 20 stock approach that they follow and have done for Alliance Trust for a number of years. But otherwise, it was just moving across their portfolio. Similarly, the GQG emerging market portfolio pretty much stayed exactly the same. And then we brought in Jennison Associates as an additional 11th manager in the lineup for Alliance Trust. All the other managers pretty much stayed the same. I'll come back to one change that we made, but all the other managers stayed the same, with one new one coming in, Jennison, who's a manager that we've known for a long time and actually use in a number of our other portfolios that we run for institutional clients. So it was an opportunity to bring them in at very low cost. In other words, it was just in specieing the stocks that they owned in the Witan portfolio into the Alliance Witan portfolio going forward. At the same time, we took the opportunity to make one business as usual change, and we replaced Black Creek, who were a manager in the portfolio and had been in there for the last 7 years or so. We replaced them with EdgePoint, and I'll come on to who EdgePoint are. So we did all of that at the same time because we'd employed BlackRock as a transition manager throughout all of this to keep the costs down, and being able to do that change at the same time meant that we were able to do all of that reorganization of the portfolio at a cost of less than 0.04%. So very, very low cost, and did it in a couple of weeks in October. So, as of the end of October, we're pretty much running the portfolio as it is today, and today it looks pretty much as it shows on the right-hand side. Now, I will come on in a bit to talk about the 2.5% legacy assets. So those were the 8% direct holdings. They're in as 6 investment trusts that Witan owned, and 2% that were in unquoted funds that in 2 of those that I'll touch on in a few slides' time. We've kept those in the portfolio, but they overall make up just 2.5% of the combined Alliance Witan portfolio. Otherwise, it's in the 20 stock best ideas approach that we've been following for the last 7.5 years, and that just continues in the new portfolio. So 2 managers that have come in, as I said. First one is Jennison Associates. Jennison, as I said, are a manager that we've known a long time. They're a global equity manager with over $200 billion in assets under management as at the end of June. Very large team, about 85 investment professionals in the US and the UK. Mark, you can see here on the team that are running the portfolio, is the key lead portfolio manager. We've known Mark for a very long time. They are an out-and-out growth manager trying to find companies with unique business models, seeing positive growth rates and a long duration of sustainable competitive advantages. So very much a growth manager that comes into the portfolio alongside some other growth managers we've got in the portfolio, like Sands, for example. So that's Jennison. Then the other manager that I mentioned that's new is EdgePoint, Canadian based. They're based in Toronto. They've replaced Black Creek. Some may remember as another Canadian based global equity manager. That we don't just replace Canadians with Canadians. That just happens to be where we found another manager that's got a similar style to Black Creek. So they are a value-oriented manager in a sense, but they're looking for companies with strong barriers to entry, competitive business models and the like, often winners in their sectors, but that looked particularly mispriced on a sort of 5+ year time horizon. So actually quite a natural replacement for Black Creek in the portfolio. So that's EdgePoint. On the next slide, this is where I mentioned these assets that have come across, the legacy Witan assets. So there are 6 investment trusts that are all on very significant discounts to NAV. We didn't think it was in shareholders' interests for those to be sold. We're quite happy owning them. We think there's some really interesting assets underlying those. We'll hold them as long as we need to hold them to realise value in those portfolios. So that could be for a series of years. We'll see how that plays out. But we think very attractive assets there. And then 2 private funds, as you can see at the bottom, Lindenwood and Lansdowne. As I said, overall they make up about 2.5% of the assets of the portfolio. So 97.5% of the portfolio is in that 20 stock best ideas global equity approach. We just hold these until it's in shareholders' interest to realise that value. So just on the final slide here, what we've got is how the portfolio looks today. And really, this is just a reminder of how we've always run this portfolio. The idea is that we want it to look pretty similar to the index on a top-down basis. So we don't take big country positions, we don't take big sector positions, and we don't take any style positions really in the portfolio. The one exception to that is that on average we'll tend to have a slight bias away from the mega cap, large cap names, and hence a slight overweight to mid cap ideas in the portfolio. That's pretty much always been a bias in the portfolio. But other than that, we don't have a value or growth bias. There might be times where it's mildly positive or negative on those factors, but generally pretty style neutral. And we're intending to make it such that stock selection drives everything. So while the portfolio looks very much like the index at a top-down level, it looks very different to the index at a bottom-up level. And one of the ways of looking at that we tend to talk about is this active money number that's on there. So active money is this: how different does the portfolio look to the index? 100% would mean you don't own anything that's in the index, so it's 100% different to the benchmark. 0% would mean that you're index tracking. You've got exactly the same weights in every stock as the index. You can see there that we've got an active money of 73%. It's generally been in the 70 to 80%, sometimes above 80% level. That's very different to what you'd see in other multi-manager approaches that would be much lower than that. That's more akin to what you'd see on a single manager approach because of this best ideas 20 stock approach that we follow, rather than asking the underlying managers to run very diversified portfolios. You can see on the top left that the style biases are almost zero. You can see bottom left that the sector biases are relatively small, and bottom right that the country positions are relatively small. We do have an underweight to the US, slight overweight to the UK and Europe. So those are really, James, I think the key slides that I was going to take people through. Happy to take any questions that come through.
Brilliant, thank you, Craig. So just to confirm then, because I think you've said it, but just there's a question here, that there's really been no change to the style and the way that the companies run.
That's absolutely right. So for a legacy Alliance Trust investor, absolutely no change whatsoever. As we've gone from 10 managers to 11 managers. That's literally the only change, but the principles behind it are identical. Indeed, even for a legacy Witan investment trust investor, not a major change to the process. It's still a multi-manager approach, but we're running these more concentrated 20 stock portfolios than previously. And of course, there's a slightly different manager lineup than there was previously.
Great, thank you. Just go back to the portfolio. Dalton is a relatively new manager in there. Can you just tell us a bit about how they've been doing, please?
Yeah, Dalton. So they've been. So Dalton is a Japanese specialist, and so the background here was that we were structurally underweight Japan. We were underweight Japan. Most managers, global equity managers, tend to be a bit underweight Japan, partly because of language reasons and the like of knowing those companies in detail, certainly down the cap spectrum. And we basically thought there was a really interesting bottom-up opportunity in that market, because there's quite a lot of change going on. The Tokyo Stock Exchange, for example, has put in certain rules that companies that are running with a price to book less than 1 have to explain what their process is to try and improve shareholder value, and so quite a lot is going on in that market. And we had a manager that we've in Dalton that we've researched for many years that that basically go down the cap spectrum and tend to focus on companies where shareholder value is being realised, and so that they've got aligned owners of the business that are doing the right things by shareholders, and they'll influence those company boards as appropriate. And so we thought there's a massive opportunity for them. A value manager, we brought them in. They've been doing fine in the portfolio actually relative to the Japanese market. Of course, the Japanese market has done less well over the last 12 months or so, mainly because of the yen movement. Yen has weakened. So overall, in absolute terms, that portfolio's not done too well. Now, we're not particularly overweight Japan. This was bringing us to slightly overweight from a significantly underweight position. But they've done fine relative to the market. They're actually seeing lots of opportunities with companies that they think are potentially going to be taken private and see a big bump in their share price as well. So there's a lot going on there. They're talking to some of those boards about realising the value in those companies, and that may be selling to a private equity firm in some cases. It may be just doing the right things in the public space and seeing that value realisation coming through.
Great, thank you. Looking at that pie chart on the right-hand side there, so Veritas and GQG's global portfolio, they're both 13.5%, so they're both quite a lot bigger than most other portfolios in there. Why is it that those two are your sort of top choices, if you like?
Yeah, so you're right. What we don't do is just base the weightings on who we've got the most conviction in. We've got pretty much equal conviction in all of these managers. We start with a principle of we want them to roughly have about the same impact on returns and risk. And so there'll be two reasons that a manager has a larger or smaller weighting. One would be just the amount of risk they typically take, and that's partly driven by the kind of approach they've got. So, for example, a small cap value deep value manager or something would have less of a weighting than a large cap quality biased manager, for example. And secondly, the other thing is how they actually fit at the particular point in time with their portfolio and how much of a diversifier they are to the other managers in the lineup. And so as we stand today, Veritas and GQG have actually got a pretty low correlation with some of the other managers in the portfolio. And so they tend to end up with a slightly higher weighting than the others as a result. They're also both quite large cap oriented and quality biased in the kind of companies that they're looking for. And so they would naturally end up with a bit of a higher weighting on an ongoing basis, but also at this particular point in time, because of how their portfolio looks relative to the rest, that's how they end up with a slightly higher weighting than some of the others.
Okay, that makes sense. Thank you. We just come forward to the things that you've got coming across from Witan. There we go. Oh, no, too far now. There we go. So the slightly interesting thing about this is it brings you exposure to asset classes, I guess, that you wouldn't get direct exposure to with the equity managers. So you've got private equity there, you've got renewables, you've got distressed debt investing, you've got property, direct real estate, biotech. Is that actually something that appeals, that you can get exposure to these sorts of other asset classes other than equities through using funds, or is that you prefer to sort of manage it back to being a direct equity portfolio?
Yeah, I mean, the reality is that the board are quite clear that they want the trust to be a global equity portfolio, and so we would not anticipate buying any other investment trusts in here at all. So it's not that we have held these because we think it gives us an exposure to these areas. We're holding these because we think that they're undervalued assets, and it's in the best interests of shareholders that we hold these and see those discounts come in from, as you can see, ranging from 20 to 40%. We expect over time those discounts will come in quite considerably. We do actually have real estate research team, we've got a private equity research team, we've got a distressed debt research team. So we know these managers and we know the underlying assets, so we can research those. But for Alliance Witan, we expect in the long term it to be 100% global equity portfolio, but we're just not going to sell when there are these discounts.
Yeah, fair enough. I agree with that. Coming back to then the sort of overall picture. One question that's popped up here that I just think is quite interesting is, and it's sort of tied to another question that's on here. So obviously the Magnificent Seven have been driving markets. You've got very large mega caps sort of distorting the way that indices are moving. Would it make more sense to benchmark it against an equal weighted market cap index rather than a market cap weighted index?
Yeah, I mean, it's a good question. I mean, over the long term, we're confident that we'll be able to beat the market cap index as stated as the benchmark. But when we report to the board, they look at us on multiple metrics. So they'll look at us against the equal weighted index, as you suggested. They will look at us against randomly. You know, we do some analysis sometimes on if you randomly created 200 stock portfolios like we run, how do we do relative to all of the portfolios you could create that own 200 stock portfolios out of that index, that were roughly equally weighted, as ours is roughly equally weighted. It's not quite true in the largest 10 or 15 stocks where we've sometimes got more than one manager owning that stock, but it's not far off that. So they look at those numbers. They look at how we're doing relative to the peer group, and that's two peer groups, both the sector average for the global equities investment trusts, but also global equity funds in the open-ended sector as well. So they look at all of those when judging how we're doing, and it's those kind of regular conversations that we're having with the board. But you know, it's a good question. We definitely look at that equal weighted index as well.
Thank you very much. Now there's a few sort of stock specific questions here, but I know you're going to tell me that it's down to the underlying managers to decide what goes in what in the portfolios. But does the portfolio have any exposure to Tesla, which has obviously gone mental since the election?
It doesn't. So it's got nothing in Tesla. So the of the Magnificent Seven, that it doesn't own Tesla. It doesn't own Apple. It's underweight Nvidia. So you can imagine actually that the biggest negative this year has been being underweight Nvidia. It does own some Nvidia, and actually it was overweight Nvidia at one point. But certainly for the last 6 months or so, it's been underweight Nvidia, and that's hurt. As you say, being underweight Tesla in the last few weeks has been a negative in particular as well. But no, it doesn't own Tesla.
Generally, what's your kind of view on the whole AI story?
Well, look, we certainly have exposure. I mean, we are slightly underweight the Magnificent Seven, so we're 4 or 5%, 4% underweight the Magnificent Seven, I think, relative to an index weight of getting close to 20% these days. But we certainly have exposure to that area. I think we definitely think that there's an interesting AI theme. The question is, where is that going to play out? And it's not necessarily just in the Magnificent Seven, right? So that's going to impact all companies in the market. And so a lot of the questions we're having with our underlying stock pickers are around what impact AI is going to have on the companies that they're investing in, either directly or indirectly. So are their competitors benefiting from this more than they are? And those kind of questions that are going on. So we definitely we're not just sitting here saying, oh, it's just a fad, this AI thing, it's not going to be real. It's definitely going to be something that impacts a lot of the market. But I don't think we would see it as you just want to invest in 2 or 3 companies if you want to play that AI theme. Obviously, it started with Nvidia in particular, and some of the other Magnificent Seven. That tends to be what happens with big themes. It'll sweep through the market, anticipating a small number of companies that it will impact, and then in time it actually starts to impact a whole swathe of companies, and that's really where a lot of our stock pickers are spending their time.
Makes sense. Thank you. Now there is a slight bias there to small cap, as you can see, but it is slight because that's a deliberate thing you tried to do. But so one of the questions here is saying, is it sort of thing that you could actually do this again, but with a small cap focus and create a sort of small cap version of Alliance Witan?
Yeah, so the bias really is away from the mega cap and large cap, and partly it's that 4 or 5% underweight Magnificent Seven piece in itself is part of that bias. But so the important thing here is it's mainly a positive mid cap bias rather than a small cap bias itself. Could we do something similar in the mid and small cap space in particular? Yes, absolutely. You could certainly follow an approach that has multi-manager in small cap space, and of course it would be a lot easier probably in recent times to beat that index than the one with the Magnificent Seven in it. But this portfolio is still designed to be large cap and mid cap bias rather than small cap.
Yeah, fair enough. Just sort of looking at how the portfolio's been doing, have any sort of managers been standing out as the best performers recently, or is it sort of stylistic?
It's quite stylistic. I mean, so so certainly over most periods you look at, GQG have been one of the best performers in the portfolio over the long term. So have Vulcan been one of the strongest performers in this portfolio. The managers that have struggled more clearly are the more value-oriented managers. In very recent periods, Sands have done particularly well on the growth side. Jennison have done pretty well on the growth side in recently. Actually, Lyrical, who are a deep value manager, have actually done pretty well. So mid and small cap US equities have done very well in recent times, and Lyrical have got certainly a bias away from the large cap, and so that's been particularly beneficial for them. So that's probably the main ones I'd bring out in recent times.
Yeah, great, thank you. You mentioned about the discount. So what do you think is keeping the discount down? I mean, are you getting new investors coming in? Do you think from FTSE 100 trackers and things? Would that happen?
Yeah. So our discount's been around the sort of 3 to 5 area, whereas the sector's more like 8, 9 for the sector as a whole. So we've definitely been a tighter discount than most, and it's been a little bit tighter in post-merger than it was pre-merger. So certainly been directionally positive. The FTSE 100 piece, as I say, that rebalance actually happens on the 20th of December. Now, clearly, some passive managers around the FTSE 100 would trade that, not necessarily exactly on the 20th, they'd start trading before. So whether that's already happened or whether some of that is still to happen, I'm not quite sure. I mean, I don't want to overplay that though, because most trackers are against the all share rather than the FTSE 100 or against the MSCI World or whatever it is. So it will be beneficial at the margin, but that in itself is not likely to bring the discount in from 3 to 5 to 0.
Yeah.
But it can only have a positive impact.
It's all about keep churning out the results, I think. Talking of which, so can you tell us a bit about the income policy and the dividend, please?
Yeah, so the thing that the board have been quite clear about is that they want to continue the progressive dividend policy. So it's well over 50 years that it's been um, uh, increasing dividends year on year for over 50 years. So it's an AIC dividend hero. That will continue. There's very significant reserves. Actually, with the merger, it was announced that the dividend increased relatively significantly in the fourth quarter as well, to ensure that Witan shareholders saw a positive increase in dividends, as well as Alliance Trust shareholders previously. In terms of how we manage the portfolio, we don't ask the managers themselves, the stock pickers, to specifically produce a particular yield on the portfolio. We're confident that over the long term, the underlying yield on the portfolio will enable us to pay that progressive dividend. But we can use reserves in years where that isn't the case. And we continue to do that, and there's very significant reserves that Alliance Witan's got going forward.
That merger with Witan, was that a one-off deal, or would you like to see the fund continue to grow through absorbing others?
So, I mean, ultimately, that's a decision for the board, but I think they would definitely see opportunities for further consolidation in the industry, and if there are examples that are going to be clearly in shareholders' interest, then they'll take advantage of that. And I think it will be in shareholders' interest to grow the trust significantly now, primarily through good performance. But also, if there are opportunities to bring in other trusts that have got like-minded view of the future, then they'll take opportunities where they come along.
Good luck with that. I think it could be great. I mean, I do appreciate what you've been doing. It was interesting you were nominee for sort of best for income in our awards as well. It's an attractive strategy, I think, and we just need to get the Magnificent Seven stuff distortion out of the way, and should continue to do well. Thank you very much for your time today, and we'll follow with interest and get you back in a year or so to have an
Sounds
update.
good.
Yeah. Thanks very much,
James.
Craig.
Nice to speak to you.
Cool. So that wraps us up for 2024. So we're going to take a break for the next couple of weeks, and we'll be back on the 3rd of January, and I'll be talking to Andrew McHattie, and we're just going to run through all of the main events of 2024 and how that's been impacting on the various sectors within investment companies world. So do have a great break, and I will see you on the 3rd of January.